Hey guys, this is Hutch with bankingtruths.com, and today we're going to talk about Bond. Not James Bond, but Fred Bond. And Fred stands for Federal Reserve Economic Data, and they've provided this nice graph on a municipal bond index that is discontinued, but gives us a pretty good sample size here, starting sometime in the 1950s, going to the mid to late 2000 teens. And we can go ahead and talk about a subject that a lot of my clients are interested in. Well, why do I have to use life insurance? Can I use municipal bonds? And the truth is you can, but after you watch this, you may not want to. So oftentimes the people that recommend municipal bonds, I notice, are baby boomers because they experienced this. I mean, you really couldn't miss. So what you're looking at here is the the y-axis is the percent yield. So this is the interest rate that you could earn tax-free, or at least federal income tax-free from municipal bonds. And if you bought them from your state, they're state income tax-free too. And when bond interest rates go down, existing bonds go up. And I'm just going to draw it for you here with my little teeter-totter, because I think this best describes it. So there's an inverse relationship between yields and principal value in bonds. And the reason why is because of this. When interest rates go down, what happens is the new bonds aren't as attractive as your old bond. And so your old bond goes up in value. Right? If somebody wants to buy your old bond on the secondary market, it's yielding more than the current bonds they can buy, so they're going to pay you a premium. Now, conversely, when interest rates go up, what happens to the price of existing bonds? Well, they naturally go down, and that's because why would I buy your old junky bond at those low interest rates that you got in 2018, whatever, whenever you bought them, when I could buy these new bonds that are paying a higher interest rate? Why would I even mess with your old bond? So if you want me to take it off your hands, I'm going to do so at a discount. So when I ask most people, which way do interest rates have to go? Almost everybody says they have to go up. Now, we don't know at what point or at what trajectory, but they're probably definitely going to go up. Probably definitely. They're probably going to go up. As you can see here, if we go all the way back to the 50s, I mean, we're very near historic lows here. So they might stay low for a while, but I think everybody agrees that this is like a coiled spring that is going to pop at some point. So let's take a look at what we can get today. If I pulled up these different tickers. Now, even though you could buy individual bonds for your municipality, it's just easiest to use nationally recognized tickers as a proxy. So these bond funds buy a whole bunch of individual municipal bonds from all over the country. If you're in a state where there's state tax, you would probably pay tax on the yield of this too. But let's just assume for the moment that you're not, and this is totally tax-free. So really, the yield here is 2.29%. And let's just say you get every bit of that tax-free. What I want you to see here is the amount of risk or fluctuations that you're taking. And it has not only, it has to do with interest rates, and it also has to do with risk. So sometimes, as you've probably heard in the news, there are municipalities that go broke. Some of them here in my home state. And so what I want you to see are the swings here. So this fund was trading in the mid 105s. This happens to be 106 at the peak if you look over here. And, not too long later, it was trading at 96, right, in the high 90s. So for something that's safe and not really providing much of a yield, if you go from 112 or even just 110 down to the low 102, 103s, 104s, even 105s, right? That could take a couple years. Like if you bought all your bonds here and you dealt with these swings and now it's down here, you kind of gave up some of your yield to these fluctuations. And even if we look at the Vanguard Intermediate Term Fund, it's got more history. By the way, notice it was paying 2.79, so it's paying a little bit more. They have a little bit higher yielding bonds. But if we go max, I don't know what was happening here in 1980 to 1982 with the municipal bond market. I was just a wee lad. Actually, I was a little bit older than a wee lad, but I certainly wasn't trading bonds. You can see here that this bad boy was trading up in the 12s and it fell to down in the 9s. Actually, all the way down to the high 8s, but let's just call it the 9s. So this thing lost 25% of its value. Um, if we look at non-municipal bonds, so investment grade corporate bond funds, well, that sounds good. They're investment grade. All that means is they're higher rated corporates. They're corporations that are less likely to go broke and pay their bills on time. But notice that during the Great Recession of 2008 going into 2009, that this fund was trading at 106 and it fell all the way to 80, the high 80s, mid 80s actually, all the way down to 105 at one point. And when we talk about using life insurance as your own private bank, I want you to remember this concept that the best deals, the fire sales on real estate and the fire sales on businesses or business equipment or inventory are had way down here. But what you're probably not going to do is you're probably not going to cash out your bonds when they're down to go into these other. And if you do, fine. Maybe you'll get more pop off these other investments, but you're still going to take a hit on your way out. Whereas if you choose life insurance with some principal protection measures, you don't have to. You can borrow against your asset that will be compounding or have the opportunity to compound and still get into these assets. What I want you to see is for these investment grade corporates, they did have more risk than the munis, and let's see what kind of yield you would have got. And just remember that there is a direct correlation with risk and interest rates. So if you see that a bond is paying more, like these bonds are paying 3.3 instead of something in the 2s, there is more risk, and obviously there's tax involved too. There are things called high yield bonds. They used to be called junk bonds, but nowadays they've dressed themselves up. They've reinvented themselves as high yield bonds. These babies are paying something in the 5s, low 5s right now. Now remember, this 5 is taxable. It's not a municipal bond, so the 5 might feel like 4 or 3 or 2.5 by the time you pay your taxes, depending on where you are. And let's just see how much risk we're taking on this front. Yeah, if you look at this fund, it started right before the Great Recession here in 2007. And so this puppy was trading at 105, and that was in June of 2007. By June of 2008, it was down to 98. And by October and December of 2008, it was down in the 70s and 60s. And the following June, it was back up to the 70s, and the following June, it was back up to the 80s, and it scraped into the low 90s and hasn't really rebounded. And what I want you to see is just some of these smaller hiccups or fluctuations going from 90 right to 77. Even if it rebounds to 85, if you bought it for 90, you need a few years of that 5% just to be breaking even on this thing. And the same thing is true with the investment grade corporates. If we go back and just revisit that, the hiccups won't be quite as volatile, but they're still hiccups nonetheless, and they don't necessarily equal the yield. You could see it was trading up here in the 120s, and then it falls down to like the low 1-teens, 110s, and it kind of channels between that. Even the municipal bonds, right? It's at 113 and it falls to 104, 103, 101. More recently, 113 down to 109, 108. Remember, you're only making 2.2% or 2.7%, whatever it is. These fluctuations could eat up your annual yield. So for that reason, I strongly recommend you take a look at what life insurance can do for you with your safe money, because not only may it provide a better yield. So like a lot of times these hurdle rates of 2s or 3s or even 5 taxables aren't that hard to beat. But remember, there's also a death benefit possibly some chronic or critical illness benefit. Now, you don't want to cash in those benefits if you can help it, meaning you'd like to stay healthy, but there are these benefits, and the main one is liquidity. We actually can create pure principal protection around this money so that when the bottom falls out of the stock, bond, and real estate market again, and there's this temporary dip and there's a fire sale, you can use your liquidity to cash in on this opportunity without having to take a major hit. Take a look, and we hope to talk to you soon.